Click the bell icon to get latest videos from Ekeeda.
Hello friends, we'll be starting Introduction of Accounts today. We'll be going through meanings, definition, terms which are used in accounts. So the first part that we'll be going through is Introduction of Accounts. Now, what do you mean by accounting? What is the exact term? Why is accounting used? All these definitions, all these terms are clarified in this lecture. So what you'll be going through right now is how the process of accounting is formed, how we understand accounting as a basic entity and a basic term, and how accounts defines every transaction, how it is an art. That is something that we'll be learning through. So let's go through the entire process and see how accounting has been an important part of this subject. Over here, I've given you a person, very renowned one, named as SRK. He has a business for himself. So imagine if he has a business for himself, there are daily transactions going in and out for him. Now, when there are daily transactions which are going in and out of his accounts, that means there are certain transactions which form maybe a financial transaction, maybe a personal transaction. Now, when it comes to accounting, you need to understand what is the process that we follow to classify every transaction as an accounting transaction and the ways accounts can be a beneficial part for this person named as SRK. So I'll be setting up a process here. I'll be giving you the definitions. I'll be giving you the details of the process which goes in through this accounts. Alright, so now when SRK has a business of his own and now we have told you that there are certain transactions that are going through his account. So how do we define those transactions? How do we classify those transactions? How do we record those transactions? This is all things that we'll be learning through this specific process. Now, just go through the kind of details that I'm providing on this sheet. Here I've given you certain codes which refer to the 7-step process that we follow while we understand accounting or while we understand introduction to accounts. Now this 7 process or this 7 step which we have mentioned down here, these are the short codes what I have mentioned down here. So the short codes mentioned down here are I, M, R, C, S, A and C. Each of these codes have a specific notation. Now, we'll go step by step into this. The first thing, I means identification of any transaction. Now, the example that we have here is SRK with a specific business. Imagine SRK has made certain transactions in his accounts, has purchased some goods, has sold some goods, has made some specific transaction towards electricity bill payment maybe. Now, the first thing that we need to identify is which of this is a financial transaction. Any transaction that refers to a specific business can be classified as financial transaction. The example that I gave through, that is buying of goods, selling of goods, paying up electricity bill for his personal use. Out of these 3, which do you think belongs to a financial transaction for his business? Yes, you're correct. Buying of goods and selling of goods is the only transaction which refers to specifications that we have mentioned here, that is financial transaction of a business. So the first thing in order to understand account is identifying what kind of transaction you're dealing with. So I refers to identification. When you refer a transaction as a business transaction, that means you know there is some financial term associated with it. That is, you have identified that specific transaction to be a financial transaction. So in order to understand accountancy or in order to understand any accounting process, you need to first understand whether that transaction is a financial transaction or not. So now that you have identified that selling of goods and buying of goods by SRK for his own business is a financial transaction, that's when you have classified that transaction to be a financial transaction here. And the bill that he paid for his personal use, that is the electricity bill, cannot be classified as a business transaction. Hence, we have excluded that transaction and it doesn't persist any kind of financial transactions in it. The second step that we'll be following through is M, that is measuring. Measuring the transaction in terms of money. The transaction that has been identified as a financial transaction has specific value. That value is always referred in terms of money. Supposingly, SRK purchased goods worth rupees 60,000 for his organization. That means the term 60,000 has been classified as the value, that is the money. So any transaction which holds financial value and has been classified into as in terms of measurement of money, that is known as measurement of that specific transaction. So the first transaction which you went through, or the first step that you went through, is identification of a financial transaction, and the second step that you had went through or that you go through right now will be measurement of that specific financial transaction that has been identified. So introduction to account has two steps. First, identifying the transaction and then measuring that transaction in terms of monetary terms. The third transaction that we'll be going through right now, or the third step that we'll be going through right now, is recording of that monetary financial transaction. Every transaction that has been identified as a financial transaction which has a monetary value will be recorded in the books of accounts. These are certain books of accounts that we'll be studying in detail following in the next chapters or following in the next lectures. However, right now, when you have identified any transaction which has a financial worth and has been classified in terms of monetary value, you need to record these transactions in specific set of accounts or specific book of accounts. These book of accounts may be journal, may be ledger, may be trial balance, may be profit and loss, may be balance sheet. Whichever books of accounts you record these into, you record these transactions. These transactions then provide you the results, the classification, which is the next step after recording. So once you have recorded these transactions, you classify these transactions into certain categories. These categories are as follows. Now, when you have identified your transaction, when you have classified them into monetary terms, when you have recorded that transaction, and when you classify these transactions into different books, that is the kind of three books that I've mentioned down here, which is trial balance, profit and loss account, balance sheet. All these three are major important books which are used when you have to define accountancy. Now, all these three books will be studied in depth in our next lecture. However, all these three transactions or all these three books are important when it comes to understanding accounts. So, the steps that we have learned so far are identifying the transactions, measuring the transaction in terms of monetary value, recording the transactions, and classifying the transactions under certain categories, which are either trial balance, profit and loss account, or balance sheet. Now, this next step that follows is summarizing. All these transactions which have been mentioned here, or all the transactions which are mentioned in the books of accounts, may be trial balance, profit and loss account, or it may be a balance sheet, has to be completely summarized so that any person who will be going through the records is able to understand what kind of transactions you are dealing with. So if you are dealing with purchase transactions, you need to record those purchase transactions together. If you're dealing with sale transactions, you need to record all those sale transactions together. If you're dealing with any kind of expenses, you need to record all those expenses together. So when you classify all these expenses, when you classify all these transactions together, that's when you call it as summarizing. So the next step which we have learned right now is summarizing of accounting transactions. After this, the next part is based on any company who has a chartered accountant will go ahead and analyze and interpret all these summarizations which have been done. So the next step is analyzing and interpretation. Every chartered accountant which is referred in the firm, or every chartered accountant which is in the firm, has a specific job which refers to analyzing all the transactions which have been recorded in the books of account and interpreting the true value of those transactions. Now, this interpretation will lead to certain results. This interpretation will lead to specifications that they have defined as, and which will be essential for communication to users, which may be internal or external. Now, when we talk about introduction to accounts, we have 7 steps which we have already learned right now. The first being identification of financial transaction, second being measurement of that financial transaction into any kind of monetary value, third will be recording of that transaction, fourth will be classifying that transaction, fifth will be summarizing those transactions into groups, sixth will be analyzing and interpretation of those transactions, and the last will be communication. When we talk about communication, communication is referred to sending out these reports, sending out these recordings, sending out all the summarizing statements in the books of accounts which we have maintained for our records to the users so that we can communicate the results where our company stands, why this account procedure was followed, and what is the result of it where the company will evaluate. What are the details that have been mentioned in the recording system? What are the details that have been mentioned in the books of accounts? All these details are shared to internal and external users. Now we have classification of internal and external users as well. Who are internal users? Internal users may be a vice president, the managing director, board of directors, any person who is related to the company and who is managing the company are internal users. They might be using this data for their management policies. And the external users are the shareholders, investors, creditors, lenders, anyone who has shown interest in the company, in the growth of their company, and they require certain data to analyze whether their money is being invested in the right company or not. So once you have all these details and once you communicate it to the internal and external users, that's when the company's true worth is shown to a layman person. That's when the company's true worth is shown, and once this is depicted via these recording systems, via these books of accounts, that's when you understand whether the company is worth investing or not. So the 7 steps that we have learned here are identifying, measuring, recording, classifying, summarizing, analysis and interpretation, and communication to the users. So the 7 steps that we have learned here are identifying, measuring, recording, summarizing, classifying, analysis and interpretation, and communication to the users. Thank you for watching Ekeeda. Keep subscribing to Ekeeda.